Show me the money. It's a phrase we've all heard, but what does it really mean? But what even is it? What is this thing we call money? Money, we chase it, spend it, worry about it. It's a constant presence in our lives, influencing our decisions and shaping our futures. But have you ever stopped to think about what it actually is? What gives it value, and why do we trust it so much? Is it those crisp bills in your wallet, the tangible feel of paper currency that we can touch and see? Or is it the numbers in your bank account, the digital figures that represent your wealth in the modern world? Here's the truth. Most money doesn't exist physically at all. It's not something you can hold in your hand. It's just information on computers, digital ones and zeros, a series of blips in the digital ether. Think about it. When you use your debit card, no physical cash changes hands. It's all about transferring digital information. You're simply transferring digital information from one account to another. It's a seamless, invisible process. Money is essentially a shared belief system, a collective agreement that these numbers and pieces of paper have value. We all agree that these digital blips or pieces of paper have value. This consensus is what makes our financial system work. They represent our ability to buy goods and services. They are the key to our economic interactions. Without that shared trust, money is just, well, fancy monopoly money, worthless and meaningless. This trust is crucial because it allows our economies to function. It enables trade, investment and growth. But this system can be fragile, as we'll see later on. Economic crises can shake this trust to its core. For now, let's delve into where this money stuff actually comes from. How is it created and who controls it?
Paper trails. The government's cash printing monopoly. Let's start with the money we can actually hold. Cold, hard cash. Governments, through their central banks, have the exclusive power to print and distribute physical currency. They decide how much to print based on factors like economic growth and inflation. Think of it like this. The government is the bank of all banks. When banks need more cash, they go to the central bank, which acts like a giant ATM, dispensing freshly printed bills. But here's the catch. Printing money doesn't magically create wealth. If the government prints too much money, it can lead to some not-so-fun consequences, like inflation.
Seigniorage. Free money for governments. Well, not really. Ever heard of seigniorage? It's basically the profit a government makes by printing money. The difference between the cost of printing a bill, a few cents, and its face value is pure profit for the government. Sounds like a sweet deal, right? Just print endless money and swim in a pool of gold coins like Scrooge McDuck. Not so fast. Remember inflation? If the government prints too much money, it floods the market, making each dollar worth less. Prices go up, and suddenly that $10 pizza costs $20. Not so magical anymore, is it? So governments can't just print their way out of debt. Excessive money printing can lead to hyperinflation, where prices skyrocket out of control, destroying economies and people's savings. Remember Weimar Germany, Zimbabwe? Yeah, not exactly success stories.
Digital dollars, where banks create money out of thin air. It's a concept that seems almost magical, but it's very real and has profound implications for our economy. Now let's talk about the money we see, the digital kind that makes up the vast majority of money in circulation. This isn't the cash you hold in your hand, but the numbers you see on your screen. These digital dollars are the lifeblood of our modern financial system. Here's where things get really interesting and slightly terrifying. When you think of money, you might imagine coins and bills, but most of it exists only as digital entries. Banks actually create money every time they make a loan. This process is known as fractional reserve banking. It's not physical cash, but rather digital entries in accounts. When you take out a loan, the bank doesn't give you cash. They credit your account with a digital amount. Let's say you get a $100,000 mortgage. The bank doesn't hand you a suitcase full of cash. Instead, they create a digital entry of $100,000 in your account. The bank doesn't hand you a suitcase full of cash. Instead, they simply create a digital entry of $100,000 in your account. Instead, they simply create a digital entry of $100,000 in your account. This money didn't exist before. It was created out of thin air. Poof! Money created out of thin air. This new money then circulates through the economy as you spend it. This new money then circulates through the economy as you spend it. You might use it to buy a house, a car, or even groceries. The catch? This money is backed by debt, your mortgage. The bank expects you to pay it back with interest. And banks can create a significant amount of digital money this way, which can have significant consequences for the economy. This process can lead to inflation if too much money is created too quickly. On the other hand, it can also stimulate economic growth by providing businesses and consumers with the funds they need to invest and spend. Understanding how banks create money out of thin air is crucial for grasping the complexities of our financial system. It highlights the delicate balance between fostering economic growth and maintaining financial stability. So, the next time you check your bank balance, remember that those digital dollars are part of a much larger and intricate system, one that has the power to shape economies and impact lives. And that, in a nutshell, is how banks create money out of thin air.
Fractional reserve banking, the risky business of lending what you don't have. This concept is at the heart of modern banking and has profound implications for the economy. This magical money creation ability of banks is all thanks to a system called fractional reserve banking. It's a system that allows banks to lend more money than they actually have in their vaults. It means banks are only required to hold a fraction of their deposits as reserves, the rest they can lend out. This fraction is determined by regulatory authorities and can vary from country to country. Think of it like this. You deposit $100 in a bank. The bank doesn't just keep your money in a vault, it uses it to generate more money. The bank is required to keep, say, $10 as reserves. This is a safety net to ensure they can meet some withdrawal demands, the remaining $90. They can lend it out to someone else. This process of lending and relending multiplies the amount of money in circulation. That borrower then deposits the $90 in their account and the bank can lend out $81 of that, and so on. This cycle continues, creating a ripple effect throughout the economy. This system allows banks to create money and stimulate economic activity. It enables businesses to invest, grow, and create jobs, fueling economic development. But it's also inherently risky. The entire system is built on the assumption that not everyone will want to withdraw their money at the same time. What happens if everyone suddenly wants to withdraw their money at the same time? This scenario, known as a bank run, can lead to financial chaos. The bank won't have enough cash on hand, leading to a classic bank run. This can cause banks to collapse, leading to widespread economic instability and loss of public confidence in the financial system.
Meltdown mayhem, when financial Jenga towers come crashing down. Remember the 2008 financial crisis? That was a prime example of what happens when the fractional reserve system goes haywire. Banks were lending recklessly, creating mountains of debt-based money, much of it tied to subprime mortgages. When the housing bubble burst, defaults soared, and those mountains of debt came crashing down. Banks were left holding worthless assets, facing massive losses. The entire financial system teetered on the brink of collapse. Governments around the world were forced to intervene, bailing out banks with trillions of taxpayer dollars. It was a stark reminder of the interconnectedness of the global financial system and the potential consequences of unchecked risk-taking.
Quantitative easing, the Fed's big bazooka, and why it might backfire. In the aftermath of the 2008 crisis, central banks around the world, including the US Federal Reserve, unleashed a new weapon, quantitative easing, QE. It's basically a fancy term for printing massive amounts of money and using it to buy assets like government bonds. The idea was to inject liquidity into the financial system, lower interest rates, and stimulate lending and investment. Think of it like giving the economy a massive adrenaline shot. While QE may have helped avert a deeper recession, its long-term consequences are still debated. Critics argue that it inflated asset bubbles, increased inequality, and fueled future financial instability. Essentially, they kicked the can down the road, creating bigger problems for later.
The debt trap. Are we all stuck in a monetary house of cards? So here we are, living in a world awash in digital money, much of it created through debt. The system is complex, opaque, and prone to booms and busts. And let's not forget the moral hazard. Banks get bailed out for their reckless behavior, while ordinary people bear the brunt of the consequences. The current monetary system has its benefits, but it's also deeply flawed. It's time for a serious conversation about alternative systems that are more stable, equitable, and accountable. Because let's face it, this whole money out of thin air thing, it's pretty darn close to magic, and we all know how those tricks usually end.